Inflation, the silent tax. After years of low inflation, it appears the sleeping dragon has awoken. Poked and prodded by central banks and governments, it's a coming, people, and it's coming for all of us. In this video, I'm going to run through some of the factors that have led to the comeback of inflation, as well as what it means for your life and your investment portfolio. The silent tax. Inflation is sometimes referred to as a silent tax because while it isn't a formal tax as such, it has the same effect in that it leads to you being able to buy less with your hard-earned money. That is, your purchasing power is eroded away. For example, if you have an item that costs $100 today and an inflation rate of 5%, that means that in 1 year's time, that same item will cost you $105. So $100 today or $105 in a year's time. So you need more money today to pay for that same item. That extra $5 that you forked out for has had the same effect as a 5% tax. Another way to look at it is if you had $10,000 sitting in the bank and you weren't earning any interest on that, and using the same 5% inflation rate as an example here, that $10,000 will only be worth $9,523 in a year's time when compared to today's value of that money. So inflation has the effect of eroding away the purchasing power of your money. That's why when it gets out of hand, it can be quite destructive. Now, if you're getting a wage rise at the same time, you might think, oh, what's the big deal? But if you're getting a wage increase of 3% and say we had 5% inflation, that means you're actually 2% worse off. There are several factors that have triggered inflationary pressures at this time. Particularly in Australia, we've had JobKeeper, cash flow boost, other state government stimulus programs. All of this has pumped massive amounts of money into the economy. At the same time, the central bank has been printing money, known as quantitative easing, and this has been taking place at levels we've never seen before. All of this has the effect of increasing the overall money supply, and this tends to lead to higher prices. We have huge amounts of money sloshing around in the economy, and all this money is looking for a home. There have also been other grants like the Home Builder Grant, and this has created a rush in building activity and created shortages of timber and other building materials. And when you have a lot of big money chasing after a shortage of materials, it will push prices up. And then there have been other supply constraints, such as a shortage of shipping containers at various ports around the world, which in some cases has resulted in the tripling of shipping costs. You've had a large portion of the population trapped in their homes, not able to travel, and in some cases being showered in government cash. For some people, it has been raining money. Now, what do? You can't do anything. So there's been a lot of online shopping going on. This has created a shortage in consumer goods from the retailers, as well as pushing out delivery times. Now, don't get me wrong, a lot of people have suffered immensely through this crisis, but it is also true to say that in any crisis, there are always winners and losers. So as you can see here, guys, there are many reasons why inflation might be about to bolt out of the gates. This isn't everything, this is a bit of a summary, there's more going on, but this is giving you an idea of the forces that are behind this inflationary beast. If you're interested in how inflation is measured using the Consumer Price Index or CPI, I made a video about that, going into it in more detail. I'll put a link at the top of the screen, you can check that out. Just don't knock my hairdo, okay? Now, normally when inflation rears its ugly head, the central bank, being the RBA in Australia or the Fed Reserve in the US, they'll raise interest rates with the intention of cooling down the economy and bringing inflation back into check. And this would also mean tapering off or cutting back on quantitative easing or money printing. This would have the effect of reducing the money supply in the overall economy and putting back upward pressure on interest rates. The problem we have now, though, is that people and governments are in debt up to their eyeballs. So if the interest rate on all that debt goes up, it can create a lot of pain in the economy because anyone holding debt will now need to come up with more money on a monthly basis to cover their higher interest payments, and not to mention the social costs that will come with it. Rates do need to go up, and they probably will, but the central banks are going to take a slow and steady approach to this. They're going to try not to alarm the markets, not to spook investors, but you can guarantee that behind closed doors, they're going to be praying like mad that inflation doesn't get out of control, because if it does, there's going to be trouble. All right, so how's it going to affect your investment portfolio? Now, it is easy to argue that in Australia and around a lot of the developed world, that house prices and stock prices probably are overvalued and that they could come down to more sustainable levels. But you also have to remember that in Australia, the housing sector is a huge part of the national economy. A lot of people who own houses have the majority of their net worth tied up in the house. And you also have to remember that the state governments make a lot of money off stamp duty on purchases, so it is in the government interest to keep house prices strong. And then there's the wealth effect. This describes how people are usually happier to open up their wallets when the value of their assets is also going up, because they feel wealthier and more financially secure. However, it also has the reverse effect in that when the value of personal assets goes down, people feel poorer and are then more likely to hoard their cash. And that's bad for the economy as well as bad for governments because they're taking less tax revenue from the economy. Now, when interest rates go up, it also tends to push the valuation on stocks lower. This is because the value of a stock is based on the expectation of future earnings. And if we want to get technical, we can talk about discounted cash flow analysis, but the crux of it is when interest rates have an expectation of going up, it will push down the prices or the valuation of stocks. And when there is an expectation that interest rates will go down, it tends to push up the valuation of stocks. You can also look at it from the perspective that higher interest rates in the future means higher interest costs on servicing company debt. Therefore, the business is going to have less money to reinvest into the business or to distribute to shareholders. And then we've got the super funds. Superannuation funds will have the majority of their investments tied up in the share market. And if interest rates go up and cause a sell-off in shares, this means that super funds are also going to take a hit. And if you're someone who is close to retirement, who was relying on your super fund to be self-funded, and your super fund takes a hit, then perhaps you might have no choice but to then look to the government for a pension. So there is a lot at stake here, guys, and it all just goes to show that there is definitely a vested interest to keep the party going. If you are going to stay invested in shares, and I'm not trying to spook you here to try and get you to sell, often it is better to stay invested than get out and maybe miss a bounce back in the stock market. But it's important to understand as well that certain sectors might be hit more than others, and some sectors that might perform better may be your consumer staples, your utility providers, healthcare, things like that. That's because these are businesses that are able to increase prices when inflation climbs. Discretionary spending normally takes a hit in a recession, so you might steer clear of businesses that rely on consumer spending for their revenue. The cyclical sectors such as mining and construction could also take a hit, as well as the big tech companies that have leveraged cheap money to grow their businesses at massive rates in recent years, especially the ones that aren't turning a profit yet. There's a few of them that have had massive gains over the past few years that are vulnerable to a correction. For those of you that are a little bit more worried about runaway inflation becoming entrenched, you might consider moving a portion of your money into more defensive assets that provide a store of value, such as gold and silver. Gold is the oldest store of value known to man. On a long enough timeline, fiat currencies come and go, but gold and silver has been there basically since, well, forever. Another option is blue chip crypto, if that's your thing, but be careful there because it's, in the scheme of things, it still is a relatively new asset sector and it is highly speculative, so it could work or it might not. But as always, it's really hard to say what's going to happen. A lot of people talk, but no one really knows what's going to happen. It's all just speculation. If it was all down to the private sector, it'd be a lot easier to see how things might play out. But the fact of the matter is you're always going to have government intervention, and depending on how they tackle this will have a lot of bearing on how it plays out in the end. And there is that old saying, do not bet against the Fed. There is a lot of factors at play here, guys, and a few interesting things happen. And like I said before, I don't want to spook you. I just want to talk to you about some of the things that I'm thinking about, some of the things that you'll be reading about for sure. There is a lot of chatter about it. And just how to understand how you could maneuver to come out of it better. But, you know, don't panic too much. Markets go down, markets go back up again, but you need to do your own research as well. None of this is advice, it's all just my opinions. I'm just trying to share things with you, so please do your own research, get your own advice. But other than that, if you enjoyed watching the video, I'd really appreciate a thumbs up. If you want to see more, hit subscribe and I'll be putting out more videos. So thanks a lot for watching, guys, and we'll see you in the next one.